European Union diplomats say the bloc is ready to hit the U.S. with retaliatory tariffs. That's if Donald Trump makes good on his threats of tariffs against countries that oppose a U.S. takeover of Greenland. European leaders are trying to convince the U.S. president to drop the idea. Trump claimed in a Truth Social post on Sunday that Denmark hadn't done enough to counter the Russian threat to Greenland, adding, quote, "It will be done."
With the threat of US tariffs as a backdrop, the Danish foreign minister is walking a diplomatic tightrope.
Well, honestly speaking, I think you must follow more than one track. I mean, we have been asking since the very beginning of this to have a constructive dialogue with our American ally and friends, free from social media and headlines and strong words. But then at the same time, of course, we need the European Union to respond. I will not develop that response at this press conference. There is close consultation going on among our European friends.
What a European response could look like could soon become clearer. The president of the European Council, Antonio Costa, has called on EU leaders to convene in the coming days to coordinate in the face of recent developments. Just days ago, Denmark was hoping for a diplomatic breakthrough in a meeting with US Vice President J.D. Vance and Secretary of State Marco Rubio, but Trump is refusing to budge on his Greenland takeover ambitions and has announced tariffs on Denmark and other European countries who oppose him. The US Treasury Secretary outlined the reasoning behind Trump's aggressive policy on NBC News, Meet the Press.
We are not going to outsource our national security. We are not going to outsource our hemispheric security to other countries. And if there were an attack on Greenland from Russia, from some other area, we would get dragged in. So better now, peace through strength, make it part of the United States.
Denmark and the other 7 European countries threatened by US tariffs have issued a joint statement warning against what they call a dangerous downward spiral, but also stating that they remain prepared for dialogue based on the principles of sovereignty and territorial integrity.
But I want to welcome our international correspondent, Keir Simmons, who joins us from Dubai. Keir, as the EU hits pause on the trade deal, what does all of that mean for the state of our relationship, as Peter just mentioned, with those, major allies we have come to count on?
Well, the Europeans are furious, they're resentful, and the impact of all of this will be felt for years to come. Now, you could argue that because of the long-standing alliance between the United States and Europe, the really Europeans have got nowhere else to go. The Germans aren't going to do a deal with China that would potentially wipe out their automotive industry, for example. But the other issue, though, is the Europeans will be asking themselves the question whether you can trust what President Trump says. Because, for example, he said about Greenland, you can say yes, you can say no, but if you say no, we will remember. Well, what does that mean? And certainly the Europeans have threatened serious economic implications if President Trump continues to pursue getting Greenland, if you like, by force, whether it's kinetic force or diplomatic force. We had the opportunity just before President Trump's speech to speak to the foreign minister of Finland, and she talked about this economic bazooka that Europe says that it is prepared to wield. Massive tariffs, sanctions against the United States, America's most important trading partner. Take a listen.
The risk of a trade war between the United States and Europe has triggered growing instability across global financial markets, raising concerns among investors, policymakers, and international institutions. Markets have reacted sharply to signals of escalating tariffs, retaliatory measures, and a breakdown in economic cooperation between two of the world's largest trading blocs. The United States and the European Union together account for a significant share of global trade, investment, and financial flows. Any disruption between them reverberates far beyond their borders, affecting currencies, equity markets, supply chains, and consumer prices worldwide. When tensions rise between these economic powers, the impact is immediate and widespread. Trade war risks intensified following renewed tariff threats, accusations of unfair trade practices, and disputes over industrial subsidies, technology regulation, and strategic industries. Markets responded with volatility as investors reassessed risk exposure and future earnings expectations for multinational corporations deeply integrated across the Atlantic. Stock markets in the United States and Europe experienced sharp swings as uncertainty increased. Sectors heavily dependent on international trade, such as automotive manufacturing, aerospace, technology, and luxury goods, were among the most affected. Financial institutions with cross-border exposure also faced pressure as the prospect of prolonged economic friction grew. Currency markets reflected the tension as well. The euro and the US dollar fluctuated as traders reacted to policy signals and shifting expectations about interest rates, trade balances, and capital flows. Increased volatility signaled declining confidence in near-term economic stability. The roots of US-Europe trade tensions are long-standing. Disputes over aircraft subsidies, steel and aluminum tariffs, digital services taxes, agricultural standards, and energy policy have repeatedly strained relations. While past negotiations temporarily eased tensions, underlying disagreements remained unresolved. Tariffs, once imposed, rarely remain isolated. Retaliation is a common response, leading to a cycle in which both sides impose additional measures. This escalation increases costs for businesses and consumers while reducing trade volumes and economic growth. Global supply chains are particularly vulnerable to transatlantic trade conflict. Many products are assembled using components sourced from both the United States and Europe. Tariffs imposed at any stage of production raise costs throughout the entire chain, forcing companies to absorb losses, increase prices, or restructure operations. Investors tend to react swiftly to trade war signals because uncertainty disrupts long-term planning. Capital investment decisions are delayed, mergers and acquisitions are postponed, and hiring slows as companies wait for clarity. These delays weaken economic momentum even before any tariffs fully take effect. The financial sector plays a critical role in amplifying market reactions. Banks, asset managers, and institutional investors adjust portfolios to manage risk exposure, sometimes triggering rapid sell-offs or shifts into safer assets. These movements can intensify market turbulence and reduce liquidity. European leaders have expressed concern that escalating trade tensions undermine economic recovery efforts. Many European economies face slowing growth, high energy costs, and fiscal constraints. A trade war with the United States would add pressure at a time when economic resilience is already strained. The United States also faces domestic risks. Tariffs raise costs for American consumers and manufacturers that rely on imported inputs. Small and medium-sized businesses often lack the capacity to absorb higher costs or quickly reconfigure supply chains, making them particularly vulnerable. Trade disputes also carry geopolitical consequences. Economic confrontation between allies weakens collective influence and complicates cooperation on security, climate policy, and global governance. Strategic rivals may benefit from divisions among Western economies. Markets are sensitive not only to policy actions but also to rhetoric. Statements suggesting aggressive trade measures can trigger immediate reactions even before formal decisions are announced. This sensitivity reflects the speed at which information spreads and the interconnected nature of modern finance. Historical precedents reinforce these concerns. Past trade conflicts have consistently reduced global growth and increased market volatility. While some industries may experience short-term protection, the broader economy typically absorbs higher costs and reduced efficiency. International institutions have repeatedly warned that fragmentation of global trade threatens long-term prosperity. Rules-based trade systems, though imperfect, provide predictability that markets rely on. Erosion of these systems increases uncertainty and discourages investment. The risk of a US-Europe trade war also affects emerging markets. Many developing economies depend on stable demand from advanced economies and participate in supply chains linking the US and Europe. Reduced trade between major economies can depress global demand and commodity prices. Energy markets have also shown sensitivity to transatlantic tensions. Trade disputes can disrupt energy flows, influence pricing dynamics, and complicate efforts to manage energy security during periods of geopolitical instability. Corporate leaders have warned that sustained trade conflict would force difficult decisions, including plant closures, workforce reductions, and shifts in production locations. These adjustments carry long-term economic and social consequences. Consumer confidence often declines during periods of trade uncertainty. Rising prices, job insecurity, and market volatility reduce household spending, further slowing economic activity. The possibility of negotiation remains, but markets require credible signals of de-escalation to stabilize. Temporary truces or ambiguous statements are often insufficient to restore confidence. As markets continue to react, the central question is whether policymakers will prioritize confrontation or compromise. The cost of escalation is increasingly visible in market movements, investor sentiment, and economic forecasts. The global economy remains deeply interconnected. Actions taken by the United States and Europe affect not only their own populations but also millions of people worldwide. Market turmoil reflects recognition of this reality. Whether tensions ease or intensify will shape economic conditions well beyond the immediate trade relationship. The current volatility underscores how fragile confidence can be when major economic powers move toward conflict rather than cooperation.
You've been watching Echoes of Africa, where every story carries the sound of tomorrow. If this moved you, subscribe now, like, and share so Africa's voice never fades into silence.